Good morning, traders. Welcome to the Flow Show. Going to start with a bit of a warning. I'm feeling a bit sweary today, so if I drop the odd bollocks or shite into the comments, please don't be offended. It's just the cockney nature of me. So yeah, forewarned is forearmed. Morning, Kay. You feeling sweary today?
Good morning, Ryan. No, because our recordings go out to a very wide audience, so I always like to use gentleman's language and not let myself into swearing as much as I would like it though. But nah.
Yeah, I'm calling bullshit on that
Yeah,
one.
Gav says there are valid technical terms. That is not false, Gav. I think that is true. For people who know dealing rooms, it was very valid. It's just part of the normal communication.
Yeah, exactly. It's a language all of its own sometimes when you can have a whole conversation in swear words and everyone knows what you mean. But okay, I'll try and be good. I'll try and be good for the rest of the webinar, but I make no promises. Speaking of promises, Japanese officials popped out of the blue last night, warning about moves in the yen. We had the top currency man Kanda saying that recent yen moves are rapid and they are closely watching FX moves with a high sense of urgency and will take appropriate steps on FX as needed. These FX moves seem to be reflecting both fundamentals and speculative moves. We perceive the yen's fall by around 10 yen about a month as rapid, suggesting that appropriate responses to a weak yen could include intervention. Suzuki was out sometime after as well, pretty much echoing those comments. They've gone from DEFCON 4 to DEFCON 1 in one hit. Okay, no build up, no gradual jawboning, it's straight to the speculative, and this is enough.
Yeah, I think perhaps they have remembered what Kuroda said a year and a half ago, that moves up to 300 points are too rapid, and then you add them on to each other, and then yeah, you end up with a 10 big figure move from the low end of last year. So yeah, they are warning because they would likely see a much more stable market. I don't know really where they stand in terms of intervention. I was just noting in the room that we are less than 1% away from those prior highs, double top. That is not a lot, because that's virtually the move we have seen yesterday on the data. So lucky for them today, there are no more data, but we have a few speakers. I don't know whether they are really ready to press the button. I would doubt it right now, but as I say, fly through it, and that's less than 1% away. Pips is still a lot. It's 130 points pips away, but it's less than 1% away. So that is a move that any dollar strength, additional dollar strength this afternoon could actually give some ideas to some dollar bulls, and if that's still the weak side, we'll go and test those prior highs again. Will they intervene? It's possible. I really don't know at this stage whether that warning is a stark enough warning. I would say, since it's the first one again after a long while of silence, perhaps not straight away. But as you say, they skipped for sure a few steps. So I don't know. A really open question to me.
Yeah, I mean, they talk about they don't act on the level of the yen, but it's a bit suspicious that the intervention chatter obviously was getting big into here and getting big into here, and now we're up there again. It's getting big, so maybe there is a bit of a line in the sand for them. But certainly had absolutely zero. Moved about 7 pips, I think, because I was sitting at my desk when this came out. Moved about 7 pips, and so the market really brushing it off. But I think we've got to just be careful that they have come out so strongly, pretty much out of the blue, which means they could be closer to intervening than they might normally be when they lay it on the line for weeks on end. But one to watch anyway in this case is if we do get that rally, that 152 is going to be an interesting level. And if they do intervene up there, that suggests, as I say, that they have got a level in mind for where they don't want the yen to go past. But we shall see. We shall see.
And I guess and I guess there's going to be a lot of barrier activity up at 153 just because of the stark rejection that we had a couple of times up there. May not be in the may not be in the reports, but I trust there is, people getting knockouts or kick-ins really. There must be some decent activity going on around there. I'm pretty convinced about that. So we may see a fly through, and then that spurs them to come in. We just need to look at the speed. It seems for them now that they've been really surprised about the speed of the move, and they never talk about it, but it is true that if you look at the crosses all the yen crosses are back to or even above levels where we saw them prior. So that may also be them saying like, well, hang on, there's something that looks to or points to speculation there.
Yeah, very much so. So we need to get behind. There's a few pairs still knocking just below prior highs. Aussie yen is one of the interesting ones that's had a really solid top out around about that 98.60s area. So plenty of levels to keep an eye on if you fancy playing with some intervention risk going on there. Right, coming across to the data this morning, start in the UK. Now, a bit of a funny one because all the press and everyone is jumping up and down that inflation has fallen lower than expected and blah, 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 blah. Right, so my view, or my opinion anyway, inflation was unchanged, okay? Year-on-year inflation was expected to come in higher at 4.1, came in at 4.0. So missed expectations, but unchanged over last month. Same with the core. Core was expected to go up a pip. It didn't, but it's still unchanged on the month. Okay, so you got one small reason to sell the quid that it missed expectations. But the fact of the matter is inflation has stayed unchanged year on year. Where the market has got a little bit hoppy is this month-on-month number, which came in lower than expected at minus 0.6. It's a valid point, but central banks and the like tend to focus on the year-on-year numbers. What also went the right way was PPI, well, in terms of for the BOE anyway, in their inflation fight. PPI, it's split between input and output prices. Pretty much all measures came in lower than expected. So that was good news, and this can be seen as feeding into CPI with a bit of a lag. So yeah, that one was going the right way. So I was a bit surprised that the quid got sold off on that data because, as we saw from the Fed, from the US, the inflation numbers there were just as sticky, and we got that reaction of strong dollar. So a bit surprised with that, bit of a head scratcher, but markets are going to do what markets are going to do. But for me, this doesn't change the tone from the Bank of England. They will still need to remain fairly higher for longer. The two hawks likely to continue voting for hikes based on these numbers as well. So I don't see any change to the voting at the next meeting unless the data changes between then. So that was it from the UK. What did you make of those numbers, Kay?
Positioning. That's the only thing I can think of. People were lightly positioned. Sterling has been pretty decent of late, and perhaps more than actually the CPI. It was probably the PPI driving it. And I think it's more positioning. Everything. Cable, yes. Seems like that needed to catch up on the rest of the dollars, perhaps. But I think it's especially the euro sterling, right? on the verge of the 84.90 figure. We were right trading there, and I guess the market was rather positioned for it to drop if CPI would have been very sticky, coming in a tick above expectations. We did see yesterday what 0.1, 0.2 can do. And they didn't get it. So then they looked at the red series of PPI numbers and went like, oh, we have to manage our sterling positions. I did exactly the same. I was long sterling yen, sterling Swiss, sorry, working well. Was short a leftover euro sterling. See if we could break. We didn't. Went back through 10 and I just went out of it. And I guess it's just a legion of people doing exactly the same. Yeah, exactly. There's this all those sterling crosses have got given a small beating. As the overall picture changed, I agree with you. This is not going to change the rhetoric from the Bank of England, but positioning does a lot, right? Sometimes you don't need to have any news at all, and yet the markets are moving. And then we look at what the sterling rates have been doing. Yeah, they did. They were a bit toppy, but then coming off between 8 and 10 BPs. I mean, it's an overreaction, but I guess it shows the fickleness of the market, the positioning of the people, and they're still reacting like I can't believe that people doing like 10-year gilts or 10-year bonds or bunds or whatever, they react like this on really one piece of data, and it must really be something out there in the bond market, but you can't ignore it because it's driving your currency. So that is what it is right now, and I think it's just that positioning this time.
Yeah, and euro sterling. I mean, that's pretty clear, showing you the policy play, the monetary policy divergence play, because you know euro dollar's coming down the same as cable, but you know euro sterling is going up on that. So you know potentially higher for longer from the BOE versus the ECB still looking at cutting. You know that's where the divergence play comes in, but. Looking at this one, this 85 level, it's still there. It's still holding. Yeah, we are going to be here in 2 weeks' time, aren't we? I was only joking last week,
yeah,
but we are going to be in 2 weeks' time. It's going to be in the same levels, isn't it?
Yeah, and I said it yesterday, right? You remember? I said like, oh, we've got a set of weaker European data, better sterling data, but wait for tomorrow. And
yeah.
The last time we had it in the same day, half an hour away from each other, those two data. But then here is just a day in between, but the reaction is the same, and but it does, you know, it gives us information. It gives us the information that the 85, 84, 90 level will be a biggie, assuming, well, not assuming, but imagine it breaks. What have we got? We've got retail sales tomorrow, if I'm not mistaken, GDP tomorrow in the UK, industrial production. Imagine they come out strong again. The market can go for another test of the 85 in euros term.
Yeah, exactly. And there's no one who watches the show or elsewhere that can not know how big this level is historically. You can see all the times it's either been support or resistance, you know, leading to some big old moves. So it's not, these levels don't come around too often. And that's why you need to look at your long-term charts, look at, you know, not just get sucked into the short-term noise, look at your long-term charts, see where your levels match up. You know, this has been an absolute doozy of a level for many, many years, and you've got to give that some respect. So yeah, that's why we've been looking at it for so long. So yeah, that was the UK data. As Kay mentioned, we got retail sales tomorrow, so it could all turn around again. I would be leaning towards a week number for retail sales. Was it Friday? I can't recall now. I'm lost track of myself.
I think it's Friday.
Yeah, it's Friday.
Tomorrow
Retail
is
sales.
GDP and IP.
Yeah, so I think Friday's one's going to be the big one, or the next big one. And I'm not overly optimistic about it. I'm never usually too bearish on the UK. but I'm not optimistic about it on Friday. We'll talk about that another time. Over to the Eurozone, and as you can see there, we had some GDP numbers out from there, and unemployment or employment change numbers. GDP flatlining. They didn't hit recession or technical recession, but doesn't mask what's happening on now. Absolutely flatlining, 0 on the quarter, 0.1 year on year. So nothing going on there. But there was a bit of a rebound in industrial production, both on the month and on the year for December. So that closes the year off with some positive numbers there. Employment change up as well. So more good news there, as long as it doesn't bring that dreaded wage price spiral that they're all fearing over there in the Eurozone. As for the squawkers, ECB's Lane says we're moving in the right direction in reducing inflation and the price trend is good. The amount of interest rate cuts will depend on how we achieve our price goal, or towards our price goal. ECB's Wojcik says we seem to be getting the inflation fight right. Let's see. It sounds like there's a few victory laps starting up from these lot, but as we're seeing with the UK, with the US, inflation isn't dead and buried just yet. ECB's DeCoste says we're waiting for more information before deciding on the rate path. Penfold, ECB's De Guindos, says the inflation is on the right track, but the ECB must watch for risks. Economic activity likely to have stagnated in Q4. These comments were before that data, so he was right about that. Says that much of the rate hiking impact is still to come. Germany, we had the usual sources pieces about their next government forecast, saying that they're going to slash their 2024 growth forecast to 0.2%. In October, they said it was going to be 1.3%, so an absolute carving there. I don't know if that's been confirmed yet. Usually those sources pieces come out the day before it's confirmed. We did have the economy minister speaking as well this morning, saying that the economic recovery may be delayed further by strikes, weak foreign demand, geopolitical tensions, and there will be inflation dampening factors in Germany likely to persist over the rest of the year. So it's going to be a while before they dig themselves out of the hole, it seems. Coming over to the data from yesterday, just before we get into CPI, we had the NFIB Small Business Optimism Index, which has been doing fairly well coming into the new year. The last few months have been pretty chipper, but it's had a little reversal down to 89.9. This is just one of those small indicators you keep half an eye on to see what's going on at the small business level. Right, onto the CPI numbers. Nice to get some numbers that move the market. Whether you make money on it or not, it's still nice to get a bit of volatility in the market. Same thing here. Inflation sticky. Headline expected to drop to 2.9, came in at 3.1. Core expected to drop to 3.7, came in unchanged at 3.9. Slightly different to the UK numbers. The month-on-month numbers went up more than expected. So overall, these numbers much hotter than everyone anticipated. Got the market in a bit of a flap. We also got some of the service sectors and owner rents and all that sort of stuff ballooning a bit as well. And all the propeller heads have been out and about. A lot of them saying it's going to be a one-off, it's lagging, it's going to fall out, and this, that, and the other. Market didn't care. It saw hot numbers. It saw the Fed having to stay at least on hold for a while longer. We were pricing May cuts. That went out the window. We were pricing June cuts. That went out the window. We priced, or the swaps price after the data, priced in less than 100 basis points of cuts in 2024. So now they're getting closer to what the Fed think on 3 cuts, which is 75 pips. So we're now under 100 pips expectations in the swaps for 2024. And there was a shift of full pricing of rate cuts from June over into July. So finally, it seems the market is starting to align more with the Fed. It's taken a while, but it's getting there. Goldies, they're booting their last forecast as well. They were last saying the cut will come in May. Now they're going to around mid-year. So they've given up a naming months. They're giving themselves a bit of optionality in that one. Pants got set on fire at the White House, according to Charles Gasparino over at, I think, CNBC. He said that panic is spreading on the possibility that Powell can't cut rates or that he'll cut into an inflation uptick, which is crazy thinking. No central bank, no Fed, no Powell is going to be cutting into inflation running higher. They're wanting it to come down, not go up. So no way they'll be cutting into higher inflation. After someone got the fire extinguisher out to all those pants on fire, White House Press Secretary Jean-Pierre said they're not focusing on 1 month data to assess inflation. Well done. Treasury Secretary Yellen said that the January CPI data shows significant progress in the fight to bring down inflation. I don't know. We just saw it all go up or remain unchanged. So I don't know how that counts as significant progress. But again, this is the world we live in. Kate, that inflation data. Well, go on. You tell us all about it, because I'm just shaking my head still.
Just 3 words, mate. Close the window. Powell was saying to shut the fucking door, but I think we should shut the window now. I think there's been enough cuts priced out. I'm not saying the dollar will correct from here, but as I've been saying on those UK data, right? The pendulum swings. The market, it shows us how this market is still very, very nervous. If you look at yesterday, the Tuesday jumped nearly 20 BPs at one stage. You saw the US 10s jumping, also nearly 20 BPs at one stage. I think the pendulum has swung now. I was just saying yesterday, I said it's lucky this week we don't have like big US Treasury issuances, especially in the longer end, because the yields would have gone absolutely ballistic, I think. But that repricing, I think, I'm not going to call the top in yields, far from, but I think the repricing is okay. Now, did we need to price out those excessive cuts? Yes, that's what I've been saying, and I've been positioned long dollars as well. Have we done enough? That's now the question to be asked, and that reply could have to wait for tomorrow on the retail sales if the consumer starts to show weaknesses. It could some of that could be undone. In the meantime, I think we are sort of where we have to be, because the tools which are usually in the old days reflecting the closest to expectations of what the Fed may do went back right to where the dot plots were or are up to now. So that is really what I think is happening now. Yeah, the dollar rose, especially. The low yielders got hit quite a bit. Swiss and yen in the lead, and here we are. And just this morning and yesterday, I started to hedge a better bit of my options, long dollar options, because I think just that repricing is done now. I'm going to keep bits and pieces on, because all of this created, versus certain currencies, wider interest rate differentials again. And that is for sure going to underpin the dollar on bits right now. But then, we on to the next set of data, because there's already stuff in there. There was like people taking all those CPI data apart, that there was a bit of an unusual jump in some of those shelter indices or so. Some of those service indices, like people didn't understand why it jumped that much, and saying that it will correct itself on next reading. So yeah, we had the number, we traded the data. Now what's next? I do think that the dollar should, in theory, remain pretty well supported because of that those data creating more interest rate differentials, although the EU rates are really following quite well the dollar rates. But still, yeah,
Yeah.
I'm still erring on that side for now until tomorrow.
Yeah, it still feels another case, you know, and we've been saying it, you know, we had all this big move in the dollar, but it is getting into a grind. Yeah, we're going to get sharp moments like yesterday, but it is, you know, there's a tailwind behind the dollar at the moment, and you've got to respect that, and the price action is telling you that. You know, Brian just asked, do I think cable should still be sold on rallies? Potentially, yes. But you never know with a quid. You know, we continue to get decent data. It's going to rally. But cable's one thing. You know, that CPI report to me isn't bearish at all, or isn't dovish for the BOE. But the dollar's outweighing it. That's what I was hoping to try and trade this week. You know, rally in cable. You know, high 127, something like that. Yeah, I would have been tapping it up there purely for this very reason, that the US data is always going to outweigh. But am I going to chase it down here? Am I going to sell 20 pip rallies? No, because we're coming through all this stuff, and it's the price is settling where it wants to settle. So yeah, it probably is a sell on rallies, but pick your spot. I think that's the main thing. But for the quid in general, you can see it move in different ways in different pairs, like we are in euro sterling. So yeah, just as you say, pick your levels. It doesn't matter what your bias is. If you like a level, then trade the level, but just know which way the wind's blowing. At the moment, the dollar's got a fairly good tailwind, so bear that in mind. So yeah, the yields finally got this break of 420. Been looking at it for long enough this year. It kicked on, and yeah, just a quick lesson on when you follow correlations, like when yields break and the yield pull on the dollar. This ran up, it hit its head on one of the next levels, carved through this one at 424, hit its head 429. We stalled there. That actually stalled the dollar. That's when euro dollar hit its lows down near 107. We saw dollar yen stalling up around 150, 50, 60s, something like that. And then when this kicked on, you would think, because you follow correlations of yields and dollar, that the dollar would kick on as well, but it didn't. Dollar yen gained, I think, around about, I don't know, 10, 13 pips, something like that. Euro dollar hit its lows, couldn't get through. So that's where that's where your correlations run out, when you get one asset or another hitting its own big levels, like euro dollar hitting 107. It couldn't go further, even though yields kept going. So that's when you see these correlations break down, because every asset has its own life and own thing to trade. Sometimes it runs into its own brick walls, even while the other asset keeps going. So it's just something key to learn from these moments. And they usually happen when you get to event-driven moves like we've seen today, big event-driven moves like we saw yesterday. But as you can see, dollar yen has been coming off and yields have been coming off. So we got no reaction to the comments, the jaw boning in Japan, but yields coming off have seen dollar yen coming off. So now we're back on the correlation. It's tightened up again. As you can see, just pop it quickly into dollar yen, although it's gone back up a bit, but you can see we're off the highs. We had a little low down to 35 odd, and now we're just hovering. I was a bit short on I went a bit short on those comments last night. I haven't taken any off yet. Probably going to kick myself that I didn't take any off in that move to 35s, but I wanted to try and push it. But yeah, I'm sitting a little bit short on this one based on those comments, and to see if we're going to get a bit more follow through on that one. Euro dollar, it's not breaking. It's had a few little pokes under the big figure, but it's not going just yet. So
it's breaking, but not breaking.
Yeah, it's breaking sad, not breaking bad. But as you can see, the bounces are getting limited to that 20 area, 25 area that was support previously and on the way down. So it's a bit of a coin toss here. Get it back above, 25s. Maybe we're undoing a bit more of this drop. If we don't, then we're likely to continue heading lower. The trend is still not looking like it wants to stop. There were some indications that it might want to stop here, but then that data wallop, it all gets washed out. So we couldn't even last a few days. So the trend is still going. It's going to need to start taking out some of these levels once more to look like it's turning around. But at the moment, as I said, that tailwind for the buck is still blowing. Again, I'm in a little bit long up here. I've been waiting for this level long enough. I thought it might be a decent stretch point after the CPI data when we were trading up near 108. It's proved a bit of a stretch point, but it's not bouncing either. So taking a little bit off. Not a big trade, but I've liked this level for a long while now. So I'm giving it a go. We'll see what happens. Kate, you didn't get much of a look-see yesterday, so I'm going to pass it over to you nice and early, mate.
Sure.
No, I'm not. Yes, I am.
Yeah, I can take it if you want. Oh, okay.
Yeah,
There we go. First of all, since it's Valentine's Day, so happy Valentine's Day to everybody. A little special message to you from our good friends at the ECB. That came up on their site this morning.
Why do you have to show me that? See, I've done well with the swearing.
I like it though. Roses are red, violets are blue. we're nearing our target, and we're real rich too. I do like it. It made me laugh. It made me laugh.
Yeah, I'm gonna have to go and swear on Twitter now. See what you made me do.
Okay. Where are we, and what say we? Yeah, Gavin, we don't have a clue. Yeah, that's a good. That's nicely rhyming as well. Okay, I
was just going over to Twitter to write exactly that.
Yeah. It's funny. It's funny. So, as I said yesterday and the days before, I mean, keep an eye on what's happening at 149.75 here, because that was the level from where we really kicked off into the end of the year on the dollar yen. We've broken above, and so I suspect that all of this here, 149.40 up to 149.70. Barring interventions, of course, this is going to be the decent support zone if the market decides to lend an ear to what the MOFers are saying, and possibly dollar finding the yields finding a bit of resistance there. This could potentially go back down to here and then find bids again. Globally, the story for I'm not going to say the weaker yen, but also higher dollar in combination is still alive, as we've already been talking about. But we are stalling around the 88.6 of this of the whole move lower. Okay, so this is I guess a good enough level to monitor going into the American session. We are turning around. A push through the yesterday's highs is likely going to attract those highs again. Look, for this whole move to start to be undone, we're going to need weaker data out of the US, because and I've been saying this enough. The Japanese yields are never or are not going to catch up on the dollar yields right now, unless Bank of Japan really starts to change the picture. So yes, you could go lean against levels, trying to have a bit of joy on the short, but in every move it's been proven, be quick to take your profits. Okay, so that is one thing. Euro dollar, Ryan showed already. He's got the 107 in there. It's really about those prior lows, right? prior lows, they held, and then we broke. This is your 61.8 from, whoops, from the, what am I doing here? The 61.8 of the end of year rally comes in at 107.12. We're trading below. The first thing that should happen for a bounce is to get back above 107.25. Then some shorts may decide that it's enough for now, and we can have a look back into the 107s. Failed to see that this afternoon. I guess we're on our way to low 106s, 105 still. But the funny thing is that differentials are not moving that much. Yeah, they widened somewhat on the US data, but we're still, barring this spike that we had in January, we're still firmly inside the well-trodden ranges on the differentials. And it's quite funny that those European yields follow nearly tick by tick the US yields, regardless whether it's just US data or worldwide data. It's very strange. In a way, it's strange. On the other side, it just tells us that the majors bond market is just one big pot of net still. Cable respect that prior low, I'd say 125.25. I did have something at 125. I guess it's those lows here and this high here. 125, 125.25. Keep an eye on that zone for support. Rallies possible up to high 125, as I say, on any corrective activity. But again, I think your main guide is going to be yields, and perhaps today we may not really get much of that because there's no data coming out, no major data coming out of the US, barring some weekly mortgage data. But I don't think they have been ruling a lot. Swissy, interesting level here. From November 22, that's where we started to. No, that's November 22. Sorry, this is when the SMB actually decided to say, like, okay, we need to combat inflation with the stronger Swiss. Remember that is where the Swiss started to strengthen. Then we had this uptick, and this is your end of year 2023, bang, lower. So those two lines those two highs together bring us to 88.85, and then we have the 61.8 of the year-end dump in dollar Swiss, 88.98, 89 the figure. Remember the euro dollar, we are like virtually trading similar kind of levels, although the Swiss has gone further and has seen a bigger rebound. Keep it in mind. Also, thanks to our friend DK in the room, who showed me that the weekly bottom of the cloud in dollar Swiss is also coming in at 88.90 today. So that's a good enough zone to pay attention to. Also, if we would say that, okay, the moves have been ample enough right now, we need to take a breather. This could be an area where we take that breather. Okay, first support coming in where? Around that my magic 80, 88, 10, 20 zone. This is a break level, so this is something, if we get back down there, where the market will pay attention to. Just below we have the 100 DMA, and just below there we have 87.90, which could be your bit of a zone under which, if the strength has to remain straight away, a stop could be placed also. But we're going to have a lot of levels to watch. I think the major zone here, if we would see a big setback, which I don't anticipate right now, that's a big move, right? If we would have a bigger setback down to 87s, 87.25, big level right now on the dollar Swiss, but that's already from where we are, more than 1.5% away from where we are. That seems like to be a big ask right now, especially also looking at some of those Swiss crosses, which I will look at now. Euro Swiss has broken, as I said. The rest of the Swiss pairs need help from the Euro Swiss. It has made a move through 94.5, made a move through the 94.70 prior high. We are slowing down. Okay, so that is also pushing me to hedge a little bit more of my dollar Swiss option this morning. We are stalling a little bit. We are getting gradually into levels where it could be enough for this round, especially when we zoom out a little bit, because we're undeniably still in a very, very powerful downward channel that's going to come in. It's still a while away. It's going to come in around 95.73 quarters. That, to me, is going to be a very, very important zone. Before that, close eye on 94.20. Prior low, prior low, prior low. Okay, we spiked above here, but it's a prior high here. And it's a bit of an extension of the last drop down, or the little drop that we saw late January on renewed Swiss trade. Okay, so this is a decent level to keep an eye on as well. Big level coming up, 95.75. If we get up there, then really pay close attention to what the Swiss is doing. If S&P, for instance, is not telling us anything, and if it allows the market to get through, it could get very powerful. Same thing on the dollar Swiss. If S&P allows us to get through those levels here, 89 the figure, I think 90 the figure is just waiting around the corner, you know. But we have to pay attention to what happens S&P side now. All right. Similar thing here. Canada Swiss, I still have a little bit running. 50% right now, and of the end of year dump and the 200 DMA. And that's where we are trading right now. So also levels to keep an eye on. All those levels now are starting to be important on the Swiss. We saw the bounce. It is a pretty powerful bounce. If you look at the dollar Swiss, we have done, what is it, 6% or so from the lows? That's not nothing, right? 6% in any pair, but in something like the Swiss, which has been manipulated so much, it's not nothing at all. So keep an eye on what's happening in all those Swiss crosses, I'd say, going forward. I've reduced a little bit on them. I still think that the Swiss has further legs to go lower, but always remember where the levels are, remember what we've done, and respect levels once we come into decent retracement. Keep a cool head, all right? Ali asking me to look at the dollar CAD. Right, we were looking at this 135.40, yeah? Yesterday, the numbers really took us through a powerful move up on the move up on all the dollars. We went into the next one, the 38.2, didn't reach 136, and we saw it come back down. I think there's a bit of oil in there, a bit of energy in there as well, but it does seem like we are having trouble to keep the highs right now. I think 135.90, 136 and a quarter, which is also going to be 61.8 of that famous last leg lower in the or the big leg lower end of year. These are levels to watch. And it's also a bit of a traffic area, 135.90, 136 and a quarter. I think for as long as that doesn't break, we could try to build ranges. I don't see too much of a reason to come off a lot either because of the dollar, but we must look at this as saying like this is quite fast running out of puff. Okay. Watch the close around 135.40 again today. We could just be hanging around there for a while, or we could come back to more neutral levels around 135 the figure. get back to 135, the figure, then I would more look like stuff like Euro crosses, like for instance the CAD Swiss that I was showing earlier. It's been a while that I looked at CAD Yen, but I trust that we are at really big levels here as well. Yeah, you see that one is actually going through major tops, right? That still shows us how the Canada is not giving up, but the yen is also relatively weak, right? Okay, what else? Oh, shall we look at metals? 1986 oil. That's your level. Pretty simple. And and then there's a bit more below here. 1970s. See, we had a bit of activity here. I'm still not inclined to have too much of positions here, but I don't know. If yield starts to cap, then this should somewhere try to find a bottom. Dale was looking at 1960. I don't really see the 1960 in there, but then perhaps I misplaced some of my fibs, or I haven't been charting it all too much. But if we see another big setback, 1940s could be on the cards. But you know, I don't have too big an opinion right now. If we start to get back above 2000 though, then I may start to have an opinion again, okay? Which is we may have seen a washout and perhaps slowly start to creep up again. Yeah, that's what there was this risk for silver is no exception to the metals. This was always the risk that we were going to have a revisit of those lower levels. We are getting into levels of interest, and I was actually looking at it this morning. We are starting to retake 22. I may just add a pinch redo to my longer term longs because I was waiting for this to happen. I've been very patient on this one, so I think well, my big levels will still be around here to add to longer term longs really, but I'm pinches, just like tiny bits here and there. I'm okay to start adding again and see if we get more for the downside or we start to move up again. Bit similar to gold, and silver can be a faster mover. 22.5. If we get back above 22.5, moving into a more constructive picture, in my opinion. And I guess, Ryan, that's more than enough for today.
Yep, thank you very much, mate. I'm already lost to Twitter. You're not going to see me for the rest of the day. I'm already on the ECB thread, chucking up replies, and everyone's chucking up replies now. Right. Very little data out for the rest of the day, so stay safe. Keep your eyes on. We've got a couple of Fed speakers out, but no big weeks. But you never know who may pop up on the presses. Just to comment on yesterday's data. So aside from that, I hope you have a good trading day. Trade safe, and we will see you all tomorrow. Have a good one, folks.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.